Going live. Hi, good afternoon, everybody. This is Ethan from Investing Note. Okay, we see attendees streaming in. Let's just give everybody a few minutes to actually come in, all right? All right. Okay. Okay, we see attendees, more attendees coming in. Another minute before we start. Okay. Good afternoon, everybody. Okay, welcome to our exclusive Fireside Chat Series where we invite the C-suite management of listed companies. And today we have Mr. Kong Chee Min, who is the CEO of Centurion Corporation Limited, right? So hi, Chee Min. Yeah. So Chee Min has been appointed as the CEO of Centurion since August 2011, all right? So, of course, Chee Min's role as the CEO, he's responsible for the overall management of Centurion's operations, implementation of business strategies, and of course, the long-term growth objectives. Joining us today is a special guest moderator, Yi Sin, who is a research analyst with CGS-CIMB for close to 6 years. And she's actually an expert at looking at both large and small cap equities in Singapore from various industries, including media, healthcare, and education. All right. So just a shout out to CGS-CIMB, who is one of the leading top brokers in Singapore in terms of total market share, with more than 70 analysts based in 8 countries across Asia, reporting on over 800 stocks in the region. All right. So a couple of house rules, everybody. If you have questions for Chee Min and Yi Sin, right, please put it into the Q&A section in the Zoom link. Okay. So without further ado, I pass my time now over to both Chee Min and Yi Sin to start this fireside chat. All right. Time is yours.
Thank you, Ethan. Good afternoon, everyone, and hello, Chee Min. Just a brief introduction about how I got to know Centurion. I remember first meeting the company way back in 2016 and had been following the company since then. I also had the opportunity to visit some of its workers and students accommodation assets in Singapore and Malaysia previously. So we at CIMB started coverage of the stock early this year, and post its recent 2Q20 results, we still like the stock and have an ad rating. The group has shown its resilience against COVID-19, with first half 20 net profit growth of 16% year on year, thanks to a bigger asset portfolio and also lower financing costs. So we will now hear more about the business and outlook from the CEO of Centurion himself. Chee Min, please.
Hi, I hope you can hear me. Thank you, Yi Sin and Ethan, for the good introduction. My name is Kong Chee Min. I'm the CEO of Centurion Corporation Limited, and welcome everybody to this session. I understand that I only have 30 minutes in terms of the presentation, so I would start now. I'll try to share screen on my presentation. Okay. Okay. So we will take about 30 minutes to run through my slides, and then we have that chat session, right? So firstly, I would have a very broad corporate overview of introducing ourselves and also the financial review of the first half results. Apart from that, later on, we'll just talk a bit on the landscape, the market, the business part of it, and then lastly ended with how the group is managing its COVID-19 pandemic situation that affects the group. So key performance highlights for the first half, we have done not bad. Our revenue is 66.6 million, in fact up 4% from last year corresponding period. This is really due to the strong first Q revenue, but this is pre-COVID-19. It has grown about 13%. Why? Because we have actually benefited from new assets that we have added as part of our group's expansion initiative in 2019. And most of them is actually, the assets actually added the second half of 2019. However, for the second quarter, and we deliberately announced or even separately put this second quarter results side by side so that investors or our shareholders can really see the impact of COVID-19, which started in about April, which is actually second quarter. So that has actually impacted us, having a decline of 5%, offsetting any growth that expected from our expansion. And most of this revenue drop is due to UK, our student accommodation, due to some lease termination, pre-termination that we have allowed UK students to do so because of their difficult or financial difficulty in actually having to manage COVID-19 during that particular period. And also for Australia, there's also low occupancy rates due to the pandemic situation over there. We'll go into detail later on. So just broadly, that's what's happening for the revenue. As for the NPAT, obviously because of the higher revenue, it has actually increased. The NPAT has increased by 16%. Higher operating costs as well due to COVID-19 in the second quarter, debt delinquency, but offset by grant income received from all the supporting packages from the government. And also we benefited from the low interest environment during this period. Just a bit of an introduction for those who don't know us very well. Over the years, we have been on an expansion spree. We have actually grown our accommodation bed count, as you can see, from 2011, ever since that we started with this business. And you can see that from 2018 to 2019, there's an increase in capacity, and that is what we are talking about, the increase in a big capacity or in view of our expansion plans. And in 2020, as you can see that, well, we have actually maintained the capacity, but yet because of the expansion in the second half, our revenues has performed better during the first half. So for our business, we are quite geographical diversified in over 6 countries worldwide. And for those rates that you can see that we are in Malaysia and Singapore, this is the workers' accommodation that we have, both in Malaysia and Singapore. As for the green ones are relating to student accommodation spread over 5 countries. Okay, to give you a bit of a flavor in terms of the breakdown, in terms of bed count and also the revenue split for the portfolio that we have. In terms of bed count, if you look at on the top, PBWA accounts for 90%, okay, which is actually 58,000 beds, compared to PBSA, which is 6,400, and that is accounts for 10% of the bed count. As for PBWA, the split between the two, as I mentioned, is between Malaysia and Singapore, is approximately 50-50% in terms of bed count. And as for student accommodation, the bigger bed count comes from UK and US, 33% and 45% respectively, and for Australia as well, which accounts for 14%. That's our bed capacity. But however, in terms of revenue contribution from the two sectors, PBSA accounts 32%, while PBWA accounts for the remaining 68%. So our business is still very much in terms of the workers' accommodation, while over the period we are trying to balance the portfolio into 50-50% in terms of revenue contribution to the group. Then for PBSA, the contribution not from the US, because US is actually a fund. We operated a fund which we own about 28.75%. The revenue contribution actually comes from predominantly UK, 63%, and Australia, 24%. And for Singapore and Korea is relatively small. Okay, this is the growth over the last few, since 2011 we started. Of course, in 2018 there's a drop. The drop is because one of the dormitory has actually expired, and the lease has expired in Singapore. And thereafter, our expansion again in 2019, and first half of 2020 is what you can see from the chart, 66 million, right? And for MPAT, you can see that it is actually growth on a year-on-year basis, except for again 2018. So it's quite a resilient, I would say, a resilient business that we have, right? Over the years, you can see that track record on growth. Okay, just a bit on details now. For the first half, 66.5 billion growth compared to last year, which is first half is about 4% in terms of revenue growth. And the revenue growth comes from, as I mentioned, due to the expansion plans. For workers' accommodation, we have this Westside Juniper, which started in September 2019, right? Then for Archer House as well, it's towards the second half of last year, which is in 2019. Well, East Adelaide, which is actually a student accommodation in Australia, even though we have started in beginning of 2019. However, that is the ramp-up period. We see that in 2020, despite of the COVID-19, even for the first half, it has actually performed better compared to last year. And this revenue growth has partially offset by the 2 months impact. In fact, because of the lease termination, there's a 3-month impact. For the 1 month impact would be in, I would say, after the first half. The 2 months impact from the UK student accommodation assets, where we allow early termination. And then for the Melbourne Dual Village, Melbourne, or we call it RMIT Village, there's some tie with the university. But because of Melbourne, as you know, that it has always been quite badly hit. In fact, now we have a second wave, so the occupancy is relatively low. So for the MPAT for the first half has increased due to the asset expansion that we're talking about, and obviously the lower interest rates has also contributed to the better performance of first half. Okay, so while we recorded revenue growth, a bit on the expenses, just to demonstrate, or rather to be a bit more transparent in terms of second quarter. Second quarter for COVID-19, we actually have to spend a lot more on operating expenses. As you know that in Singapore there's an outbreak for operationally for our workers' accommodation, and therefore we have to spend about 1.3 million, increasing in manpower costs and also related COVID-19 precaution measures in order to contain the spread. And then the revenue, I think I explained. There's a reduction of 3.1 million, right? 2 months is actually 2.5 million in second quarter. And then the reduction in occupancy, as I mentioned as well. But one more thing that we have actually put in, or rather provided in the second quarter, is actually doubtful debts. We have seen that there's a bit of, I would say, increase in terms of the level of debts that we have. Predominantly, I would say, is due to the fact that the various countries in the region has actually come out with this law to say that we cannot evict any customers during this period. We must allow them to defer. So specifically for individual customers, we actually run through our own aging debt, and then we come out that we should provide on this 1.2 million due to experiencing a financial difficulty from our clients. So, however, all this negativity is impacted by government support schemes of various jurisdictions, 1.6 million, and also reduction of finance expense due to the lower interest environment of 1.5 million. On business segment results, as you can see that the segment, this is workers' accommodation, the segment margins has dropped about 2 percentage points, despite of the fact that the revenue has increased by 12% because of the new asset, Westlight Juniper, that we talked about, purely because of the increase in cost. Then for student accommodation, there's the margins has actually stayed relatively similar, even though that there's a reduction of revenue or because of this UK predominantly, but because we have also got new assets in Nottingham that has actually cushioned the impact. So for optical, this is a very small segment that we have. We still present this. Obviously, optical, this is also impacted by the circuit breaker and also the pandemic situation, but that is not very material to the group. In terms of balance sheet, I would say that our cash maintains relatively strong. It is 65 million, up 34%. This is due to the increase of, or rather the profitability and the cash flow generated from the operational activities during the first half. And the loan moratorium that we actually seek from the banks as well. So there's a moratorium being put in place, and therefore repayments has actually reduced. As for the non-current assets, and is merely due to the exchange translation losses, right? In the UK because of weakening of currencies, and there's some transfer into industrial properties in China. We still have a factory in China. We have put that on sale. We are now in the progress, or rather we have signed an SMP. Is actually progressing towards completion. As for current assets and current liabilities, merely due to the moratorium of 1 year. So that's account for the movements. And average long-term debt is still remains at 7 years in terms of our maturity profile. Interest cover is well within threshold, which is 3.4 times. Earnings per share, as for first half is 2.5 cents versus for full year last year 4.6 cents. For the first half, because of the performance, is actually relatively quite good. But the second half headwinds, which we'll talk about it later on. So in terms of share price and earnings per share, it has actually improved. Okay, so in terms of the headwinds, this is a general risk that we see that this COVID-19 will impact our business. Firstly, the pressures experienced in second quarter that I mentioned. Further headwinds also expected generally due to the market, the economy, because especially for workers' accommodation, the economy does have an impact on the demand for the workers' accommodation that we have in Singapore and also in Malaysia. And all those restrictions like travel bans, movements, border closures, as what you can see, that would also have an impact. Then the impact also from the university point of view, whereby they would reduce face-to-face teachings, operational costs too, that could also increase in order to contain COVID-19 operationally on the ground. So there are also other impact that we feel from the customer too, review of lease terms, pre-terminations, rental deferrals, waivers and all that. And also, I mentioned the government, because of COVID-19, they have come out with unprecedented laws and regulations that would also have an impact on our debt delinquencies. And also, we also expect to see if really that the COVID-19 worsens and there's a second wave, and therefore it increase further economic uncertainties in the market. So these are all the risks associated to our business. Okay, very quickly at a glance, I mean, for workers' accommodation, we have about 12 operating assets, 5 in Singapore, then about 7 in Malaysia. So so far, in terms of the occupancy rate in first half is about 98.5% in Singapore. Malaysia is 79.5%. Malaysia is slightly lower because of we have an asset called Bukit Minyak has actually started only last year, but because of the COVID-19, the occupancy has not actually grown since then. Okay, so apart from that, we also secured some management contracts from JTC to manage 4,200 beds in 3 sites in Singapore for a period of 6 months plus 6. And this has actually went operation, particularly for 2 of them. So for workers' accommodation, just a bit on the landscape. Actually, I feel that COVID-19 impact has yet to be seen, the full impact, I would say, because the impact on this virus control measures on them, it has actually hit the employers' business in the short run. I hope it's not towards the medium term too. But again, because of the fact that we do need to I would say adhere to government quarantine and SHN measures and all that. So that we feel that would actually impact the employer's business. And obviously, if they are impacted, we would actually be impacted as well. Then there is also regulatory changes in terms of purpose-built dormitories, which we will talk about it in detail later on. Obviously, for circuit breaker, we mentioned as well, all the workers actually stayed in our accommodation 24/7. That puts a bit of stress in terms of operating costs and also the measures that we need to stringently adhere to. That is during that period. Hopefully, it doesn't goes into future periods and no more circuit breakers. Then obviously, we are working very closely with the government and also other stakeholders to contain the spread within the migrant workers community. As for the status now for our workers accommodation in Singapore, it is all cleared. The dorms are all cleared, no longer except for 1 block. At the moment, it's all cleared. So a lot of workers has actually resumed to work. So a bit more details. Very quickly, employees, as I mentioned, they are pressured by, in terms of the number of workforce that they are able to do the work. Even though now, there's some resumption of work, but some we knew that because of virus transmission, some projects has to stop for a while, having to I would say adhere to quarantine measures for certain sites. Hopefully, there are not more, but that is real. Even though all the dormitories are being cleared so far, then there are also issues about the business rental affordability and also payments, which is why we see that this could be a issue going forward. If really that they are further disrupted, then that delinquency may happen. But so far, because of the fact that the government has actually supported them very well, we don't see that the impact, because I mean, our financial occupancy is relatively high. Debts are still paying, except for a few, that's where we are provided for. But commercial business inside the dormitories are affected as well, because they are closed due to the fact that they are not supposed to operate a business. The workers are actually in the rooms. And they're isolated to the rooms. In fact, we actually have online deliveries, etc. But again, that has actually impacted them in terms of business, purely because during that 4 months period, the government actually provide food and catered to them. And obviously, like commercial business, like supermarket in our accommodation, would actually be affected, because then sales will drop. Okay, and then COVID-19, there are also new measures that are being introduced. Some of the measures include increasing the bed count temporarily. It was announced in the papers, or the government has announced that they have actually increased about 60,000 beds, which I'll come to that later in the short to medium term. And on the long-term basis, they would actually increase another 100,000 beds, right? So, however, the group still believe that the demand for workers' accommodation stays relatively stable and strong, purely because that there are insufficient supply in the market, which I'll come to that in the next slide. So this is what happens in the landscape pre and post COVID. Pre-COVID, if you look at the supply side, right? Of course, there are about 700,000 foreign or rather work permit holders in Singapore. Not all the 700,000 workers required accommodation in the purpose-built workers accommodation, or we call it approved accommodation, because some of them can stay in HDBs. Or even private residential buildings, right? So in terms of supply, you can see that we only, in terms of the long-term space, we call it long-term. That means those are reinforced concrete, just like any HDB blocks, as you can see. This is about 100,000. Then the short-term space is also about 100,000. So we are the short-term space means that they are in short-term tenancies, like 3+3+3. They will expire sometime. This is the one that has all the community toilets and community kitchens and etc. The one that came out in the papers for S11, those are the accommodation that with the communal toilets and communal kitchens, which is the most challenging during pandemic times. But for ours, in terms of the long-term purpose-built workers' accommodation, for ours, we have on-site toilets and on-site kitchens. So we are able to reduce the bubble. They call it a bubble because they are able to stay self-sufficient within that particular unit, because they can cook in that unit, not having to go to a communal area to do cooking. So our accommodation are well placed in terms of facing the pandemic. This is 200,000 beds, right? Of course, the rest of them, like factory converted, the on-site dormitories, etc., They have no common amenities thus far. Catering of food, toilets, some are shared as well, but they are all distributed within Singapore, all over the place, right? So this one accounts for about 100 to 150,000 beds, right? So this is actually the pre-COVID arrangement. But during COVID, the government has actually decanted quite a fair bit of workers to various sites, right? Some are in quarantine facilities, some are in recovery facilities, some are also in um, 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 I think you all know that there are the expo, the various uh, communal areas within Singapore, whatever they can actually use, um, factory converted sites, new factory converted sites, new what do you call those um, um, uh, swimming pools or community facilities, whatever they have, they actually use it, even army camps. So they are all decanted to these places, but these places is only very temporary. They need to consolidate and thereafter open up back to normalcy as well. So how could they actually house them? Most of the workers currently are returning back to the dorms. We can see that they are returning progressively from decanted sites or also uh, um, um, the quarantine sites. Um, so there will be a shortage, okay, if really everybody returning back. And because the government wanted to have some kind of the densification as well, right, in terms of the number of beds that, or the or rather the number of beds per room in that the foreign workers can stay. But that is not something that they're fixated yet because of the shortage. So they're waiting for, in fact, they are building up 60,000 beds as they have announced. Some has actually come online. Um, the some beds that we are managing belongs to these 60,000 beds, but progressively they are coming on towards the end of the year of 2020. So it's only 60,000 beds, but these 60,000 beds are meant to replace those current facilities that use temporary but close, and then this will actually goes into the 60,000 beds. Um, and and also to address the issue of de-densification, and also to address also within the 2 to 3 years, whereby depending on how the standards goes, some retrofitting and enhancement of the dormitories will need to be done. And during then, where do the workers stay? These workers will be decanted to these sites. So this 60,000 is really a temporary measure, but the government also mentioned that they are in the transition of this 60,000 beds, they are going to build up another 100,000 beds. These are really the permanent dormitories that we are talking about over the next 1 to 2 years. If you take a look at all that, the real increase is actually the 100,000 beds that we are talking about. But not forgetting that these sites will be decanted. Some of the temporary ones the lease will expire, right? Because the structure cannot actually be that long, and also the site maybe they need to use them. There could be a deferment of the lease of this short-term PBWA in the transition. But overall, if you look at the landscape, the accommodation is still relatively short, and I would say that it will be healthy. If you are looking at this 100,000 beds over the 300,000 beds, you do a division, it is actually about 30%, right? That's the landscape that we are talking about. So therefore, in the long term, we see that the demand or even the supply and demand will be very healthy. Okay, for Malaysia, it has actually not affected Malaysia very much. There's zero counts of COVID-19, but of course we needs to be vigilant and to ensure that there's no cases in the workers' accommodation. The specification makes somebody ask whether it's the same or not the same. Actually, they are the same. We actually borrowed or rather use the same specification in Singapore and actually do that in Malaysia. The impact for COVID-19 is not not felt, I would say. Most of them is due to the fact that there's this restriction on foreign workers entry, and gradually we do see an impact on replacement because of workers goes out, then there's they can't come in, and therefore there will be a reduction. Not that significantly felt, but there would be this reduction. The government also tried to say they are going to restrict hiring of foreign workers in different sectors as well. These sectors are not the sectors that we are currently in. However, depending on how things goes, because I think the quality of accommodation now due to COVID-19 is a bit more, I would say, the demand in terms of this accommodation is heightened, and therefore we believe is that there's an opportunity over there too. So in terms of our, I would say in terms of customer base, we have 812 customers in Singapore, both in Singapore and Malaysia for workers accommodation. It's quite diverse. No single concentration of customers. In terms of sector as well, we are not singly rely on any particular sector, even though for construction is 48%, but the rest are quite well spread. Okay, then we go on to the student accommodation. In terms of student accommodation, obviously is in general, this is the general landscape. It is impacted by travel bans, border closures, university actions, and also depending on when it first is that the economy is going for the different countries. It does have an impact because of their parents, etc. But to what I can see is that because student accommodation, they can actually easily get loans and tuition loans. So that part in terms of impact of economy is economic impact is much lesser, which is why student accommodation is very resilient. So we believe is that after which all this, if the university opens up for reopening of the university, obviously this issue in terms of occupancy rates will just go. So in terms of long-term wise, we are pretty upbeat about the strong, for student accommodation. So we in UK, we at the moment we have or rather in the total portfolio we have 21 assets, right? For UK it accounts, I would say, predominant most of them in terms of the number of assets, but average occupancy for the first half is 74%. Australia, both RMIT and Adelaide add together, 68.4%, used to be relatively high. Singapore, for our small dual Seligi is about 80% occupancy. For US, we never disclose in terms of its occupancy because it's actually a fund, it's confidential, we shouldn't do that. But the occupancy rates are quite good. For South Korea, because Korea is actually badly affected by COVID-19 as well, the occupancy rate currently is only 25%. But this is a small asset that we have, so it's not really that material to the group. Okay, a bit of landscape for each and every country, a very quick one. UK, as you know that UK is also badly affected by the COVID-19. They have actually announced several measures that they have made. But again, there are no, I would say is that in terms of the measures are not so draconian compared to Asian countries. As far as there's no border closure, so to speak, students can still go into UK relatively easy, and they welcome them too. It's just that they need to stay. I mean, I think a stay-home notice of 14 days and that's it, right? There's no real border closures. But because of the situation over there, international students are also a bit more reserved in terms of going into the UK, despite there's no border closures because of the infection rates over in the UK. But we can see that as far as the university is concerned, some of the countries that we are operating in are some of the cities are pretty healthy. The one that is a bit more challenging is Manchester, which we unfortunately we do have a fair bit of assets over there. That has been softened due to the fact that the infection rates are very high. But I think the university has actually announced clearly that when they wanted to open up for face-to-face or even blended teachings, which is good for us. As for Australia, Australia is actually really in a lockdown position. As you know that they are in stage 4, I believe, for Melbourne. That's a second wave. We have no crystal ball as to what it is, but we believe is that while there are some tapering off in terms of the infection, it will take a while. The lockdown, I think, ends in 13th of September. We have yet to see what happens next. For Adelaide, is not so bad. It has actually announced the opening for face-to-face in September. Okay. Singapore is we have 80% occupancy right now. Is impacted by the fact that SLA has came back to us and said that while you reduce the capacity from 332 to 240 beds, so we are currently in progress with SLA to look at the financial impact to that particular business having to maintain at 240, and how long would these measures that they are implementing for that particular asset. Korea, as you know, that is still very bad. So at the moment, I have no crystal ball, but again, we just got to see how bad this situation lasts for Korea. Fortunately, similarly, the asset is relatively small, so the impact to the group is not really that material. For US, is a bit interesting. US is hardly, even though we know that there's a lot of cases in the US, right? Death rates as well. But again, because of the Trump effect, we don't see any effect as far as US is concerned. In fact, the student accommodation bookings for us is actually better than last year because we actively involved in terms of the marketing of that area. So managing COVID-19, of course, this COVID-19 is actually an unprecedented kind of situation. So we do need to also respond in a manner that is unprecedented. So a lot of things that we are currently doing as far as development plans, we have actually halted them. Like for example, Toh Guan, we have deferred the start of the process. For Tham Poi, we have one asset in Malaysia as well. We have put it on hold, but likely that we will continue with that gradually and progressively, purely because that we have already started this construction prior to the COVID. So we just cannot hold that for too long. So those essential capex we will still need to spend. But again, is that those are relatively small. So we still need to consider. We will still consider attractive opportunities that is available. Like for example, in Singapore, there is opportunities due to the fact that the government wants to build more workers' accommodation. So in the short to medium term, what we will do is that we will focus or strengthen our operational and management capabilities in many areas. Particularly, we wanted to mitigate the effects on COVID-19 into the operations as we need to put in more measures, right? So we leverage on technology in order to do that. We're also taking steps to control costs. In fact, within the group, there are some salary cuts as well in order to control manpower costs. And also we are conserving cash resources. Obviously, we will tap onto relief packages that is available. We have also approached to our bankers for moratoria on principal repayments. In fact, it is very well supported. For dividends, so we have actually freeze our dividends thus far for the first half. For cash and unutilized committed credit facility, we have 167 million. So we do have sufficient liquidity to meet any debt obligations and fall due. But in the overall long term, we certainly believe that for PBWA, the demand is expected to stabilize in the long term. As demonstrated pre-COVID times, the demand has been quite strong. After COVID, we believe that it will come back relatively strong as well. As I demonstrated to you that the new bids of the 100,000 bids, they are just able to balance up the occupancy that the government is trying to manage in terms of densifying each and every existing dormitories, and to retrofit them. Then, so for opportunities wise, we would actually pursue any kind of opportunities in this business, particularly in Singapore, for management service contracts as well. The government also talks about building QBDs. We will participate in that as well. For PBSA, it's quite clear. Pre-COVID is very, very strong. And we believe is that if things are turning better and the universities open up for face-to-face, even though half of it and alternate weeks and all that, our accommodation will actually be, or rather our occupancy will actually normalizes. And if the border closures is being lifted, I mean the recovery of our assets will be very, very strong and very, very fast. Okay, I hope I have given you a good. I'm trying to rush it through so that I hope I've not overshot the timing. I think over back to you, Yi Sin or Ethan, for questions. Yeah.
Okay, yes. Thank you, Chee Min, for the presentation. We will now begin our Q&A session with the audience. Just a reminder, questions can be raised by typing on the Q&A box on the Zoom app. So we will kick off the first question on COVID-19 disruption, focusing on the PBWA business. I think we had some questions on the new measures by the government, decentralization, new living standards, for example, single beds, maximum number of residents, and minimum space requirements. So do you foresee, what kind of impact do you think this will have for Centurion's PBWA business? And also, do you still see room for expansion for PBWA?
Okay, thank you for the question. I think it's very relevant to our business. The government does announce that the new standards, we are in constant, I would say, conversation with various sector leaders and also government to look at what is the standard that is beneficial to not only the foreign workers, but also to the Singapore community. Is this the new standards that would actually help or not help? Are we, I would say, these new standards, are they actually wanting to cope with pandemic? Is it the new standards to cope with the pandemic, or basically is for the better welfare of the foreign workers? I think there are two different things. The standards that the government has come up with is, I would say, exceed the international standards, right? The international standards is what currently the government is actually having, 4.5 square meters. That means the existing standards. Double-decker beds, no single beds, and also the requirements of all the amenities, etc., etc. First of all, for Centurion, the impact in terms of having an ensuite toilet, in fact, we have an ensuite kitchen, which is even better than the new standards. The new standards do not actually require ensuite kitchen, shared kitchen, but ours is actually ensuite toilets and also bathrooms and also kitchen. So therefore, the impact from there in terms of having to spend more money in terms of retrofitting, that is not there. The standards that talks about the reduction on the bed count, 10 per room, we should be able to comply. That's not an issue because it's only in terms of the arrangement of the beds. But the only one that is very challenging is actually to say that they cut down from double-decker beds to single beds, and that double-decker beds to single beds that come from the perspective of containing pandemic. That means in a room, even though you have 10 per room, which is what the new standards require, but all must be single beds. So the question is that whether 10 per room, if they are inside there, I don't think they are able to. I mean, that's my perspective, right? Even though we are 10 per room, they are sharing the spaces. You can't be wearing masks in the unit. You can't also have the kind of SDM, right? That we do, just like what we are in at our homes, right? If it's really there's an infection within that unit, it's likely that it will affect the rest of the 9 of them, right? Um, I think the measures that they're talking about, that of course when they're staying in the second or rather the higher level, because of the I would say the saliva, or the what do you call it, yeah, the emissions from your mouth and all that, right? So that would actually I mean it travels down, and therefore infection escalates. So that one is actually that one I wouldn't want to go there, but this is what the medical people says. But that is actually the most difficult ones for us to comply. Not that we cannot comply, it's just that when we do that, this space in terms of the optimizing use of space will not be there. As you know, that ours is actually purpose-built workers accommodation. The columns and the walls are relatively fixed. In order to do that, we can, but then the spacing of the beds will actually eat into common living space in the apartment, like for example dining areas, that kind of thing. So it's not very ideal for living experience. Again, I would qualify to say that this is what we have actually feedback. I think the government has no intention to apply 100% standards as what they mentioned. The government also have not actually come back to say that, well, these standards are the standards that they are going forward. The government only say that this is the new standards that the proposal being put forward. They are going to review. In particularly is that they are going to they are piloting these new standards into the QBD that we can see, and these are things that possibly that the process the government is still undergoing, and therefore I wouldn't say that the standards are really cast in stone. Yeah, Yi Sin.
Okay, yes. We have a few follow-up questions still on PBWA. I think there was a question on, for the meals provided, is it given by the company or they have to be outsourced to centralized kitchen? And the second question on, could you give some color on Centurion's partnership with Lian Beng? Because they understand that they also have a share of the PBWA market. So is your relationship more of a collaborative style, or do you see them as a competitor?
Okay, that's an easy one. So for food, is being catered by the government, right? During the pandemic period, so the cost doesn't come from us. The government actually pays all those. If that's the question, but for us, even though going forward, usually the catering in terms of providing food and all that is not very much our concern. Why? Because the workers cook. So we have on-site kitchens, and not like what we mentioned is the ideal thing, that they don't need to share kitchens with someone else. So the challenges that our accommodation faces compared to other dormitories are different. The rest of the dormitories, if they have on-site kitchen or toilets, frankly they have a huge challenge in terms of maintaining that, particularly for segregation. But we don't have that issue. The workers are very happy. They will cook themselves. They buy the groceries from our minima, and they cook themselves. As for Lian Beng is actually our partner. They are not a competitor. In fact, their accommodation is being managed by us, right? I mean, I would say that the workers' accommodation is being managed by us. So they are not in competition with us. Yep.
Okay.
Sorry, I can't hear you, Yi Sin. Yeah.
Yes. Sorry, I was trying to unmute myself.
Okay.
Okay, I think there was another question. Okay, so post the recent general election, there was a lot of talk about improving productivity of workers, right? And possible reduction of foreign workers going ahead. Do you think this will impact Centurion?
I think is a natural process. I think it will come anyway. I mean, the reliance on workers' accommodation has been a discussion point for many years already, to reduce the reliance on foreign workers, um, increase productivity, etc. But there's an extent that how much you can actually reduce in terms of the productivity, right? 20% perhaps, right? It can't be 100%. Replacing all the foreign workers. So we are in the permanent space. We are in the permanent workers accommodation space. We have a long term. We have freehold. We have long leasehold as well. So the impact on us will be relatively low. Why? Because if really that there is a reduction in, I would say, demand. Similarly, the first one to go would be likely to be those 3+3+3, which is actually temporary, right? Because that accounts for 50% of the PPWA in Singapore market right now. Easy?
Okay, yes, okay. Yes, so okay, then because you recently mentioned that you have secured some management contracts, right, from JTC. So I think there's a question: how profitable are these contracts? And do you think you are in a very good position to win more of such contracts?
Well, we work. I would say is that I can't share with you how profitable they are. Of course, during this time, managing of workers' accommodation is not that easy, right? Purely because of the fact that there's infections. Not many people likes to work in a dormitory. I mean, to be honest, in fact, they shy away, including our vendors and all that. So it's a difficult time that we have. So I'm also quite glad that our staff during this time, even the headquarters staff, has actually gone on site to tackle the ground and help the operational issues that we have on a day-to-day basis. So obviously for that return and reward, we expect a bit higher, right? To manage such facility, right? But again, I wouldn't say that it is margins that we can earn very, very, very high fat margins for these contracts.
Okay, yes. Maybe we quickly move to PBSA first. So there's a question on whether you think there is ample of room for growth in UK market. And also maybe some colors on the PBSA assets in the US. How are they performing?
Okay, for UK market as shared, it depends on different cities. In fact, there is a lot of opportunities that we see in UK, right? There's still a short of purpose-built student accommodation. A lot of where does a student stay? They basically stay in private housing right now, right? That takes away a lot of private housing, residential needs away from these cities. So in fact, the government or the city councils, they are encouraging more and more student accommodation. And as you know that UK is has a big education market. It attracts a lot of international students, right? Pre-COVID, I think post-COVID it would be the same as well, because of language, because of the top universities in the UK and the way that they open up. So we feel that the opportunity is still quite a fair bit, which is why gradually we have been actually going there nonetheless, right? Manchester is second compared to London. London, you know, the infection rates are high. Obviously, Manchester will be high as well because similarly is a metropolitan city. But the rest of the city, like what we see, Nottingham, Liverpool, Bristol, right? The infection rates are relatively well controlled, low, and our occupancy rates, I would say, is that even for pre-bookings is in excess of 90%. So you can see that in terms of the UK market, we are still very bullish. In the US market, similarly, of course, contrary to what we think that at first it would actually have an impact on COVID-19, but the impact is very minimal. Of course, I think it's also not due to the fact that the portfolio that we have, the international students accounts for only about 2% of our portfolio, but the rest of them are really locals. And the locals, as you can see, that they are not so concerned about COVID-19 compared to us. So that has actually not impacted. But again, for these two, or rather for student accommodation in the long term, we feel that there are still a huge amount of growth for the group.
Okay. Thank you for that. And I think, so there was a question on PBSA. Are they strictly for students, or actually, it's open for rent by the public on a long-term basis?
No, it's all for students. But of course, in US, there's no such thing called purpose-built, or really we cannot, even though it's purpose-built, we cannot say that, well, it's only for students. There's some act to say that, well, for free, if any adults wants to stay in there, we cannot reject them, right? But again, I don't think anyone will want to stay with students, right? So they are meant for students, and that's where our expertise is in terms of student accommodation.
Fund to act as a catalyst, or what other catalysts for the stock do you see?
I think more so, I hope the investors look at it as a long-term investment. Of course, COVID-19, we are not spared. Even though you mentioned that it's resilient, yes, I think before that we also say that it's resilient, but I think it's not so resilient when it comes to COVID-19, right? But hopefully is that this thing is a temporary one. I believe everybody knows that the impact to the economy is very, very great too. I mean, for COVID-19, and hopefully the economy doesn't go into a tailspin. But I don't think so. I think the world will come to a conclusion as to how in the first place they manage this, even though we don't have a vaccine. So in terms of the long term, in terms of business, our business is not being displaced like some other business as well. We still need physical accommodation to stay, regardless of whatever. You can't stay online. So we are pretty bullish in terms of the business that we are in the long term.
Okay, so maybe I'll take we have two more questions. One on dividends. So if you have suspended the interim dividend, but you have paid 0.02 annual DPS in 2018 and 19, how should we think about the dividends for this year and next year? And also a question on your debt profile. The 50% gearing looks quite high. So any plans to reduce the debt over there?
Okay. First question in terms of dividend, I think it's all related. I think for dividends, we even though our results are good, I would say, but we intend to conserve cash as much as possible because this is really unprecedented, and then we don't have crystal ball as to whether the economy will really go into a tailspin. So we are really conserving cash and consolidating our management capability, right, in terms of riding this through, which is why we have not paid any interim dividend. But again, that depends really how the market goes for the second half. If really that the uncertainty goes, vaccine comes along, right? Then again we will be back to normal. As for the debt maturity, the debt is 50%. I don't think that 50% is high because our business in terms of of course, apart from the resilience that we're talking about, even though in times like that, one thing we have to note also that there are also unsecured debts compared to the secured debts on. We do have an MTM in there as well, but it's due only in 2022, right? And then those debts, in fact, most of the debts are pledged on the assets, and refinancing of these assets, some of them are relatively low, 30% and all that. It's not all at 50%. So we have the ability to refinance them as and when we want to. So coupled with the fact that as disclosed, that we have these committed lines, right? We are quite comfortable with that kind of debt level.
Okay. Ken, maybe the last question. I saw a few questions on potential listing of a REIT. I think a few years back there was some talk about it. Is there any update, or is the company still looking forward to such a REIT listing?
We definitely look at REIT listing as a vehicle for us to expand even further. I mean, we all know that REIT listing is the way to go, so that it is not so asset heavy. Our business is actually asset heavy, right? If you have a REIT vehicle, we can expand faster and even bigger. So that has always been our plan. We have not actually said that no, we are not going to do that. It's only a matter of time. Unfortunately, due to this COVID-19, in fact, we are preparing something. Of course, we never, but I'm not supposed to say in terms of what the details are. But again, because of COVID-19, we have actually no choice but to stop. It's not only about us. It's also about the partners that we work together as well to make this REIT happen. So, well, I think for the investors out there, I just got to tell you that this strategy will never stop, right? One day we will get to REIT. It's a matter of timing. At the moment, it's not a conducive time to do a REIT.
Okay, thank you. So in the interest of time, we will conclude the Q&A session. Chee Min, do you have any last words, or we'll hand the time over to Ethan?
I think I've said enough. So unless you have any questions, I'm okay to stay a bit longer. I mean, to answer any burning questions if you do have. If not, I think I can hand over to Ethan.
All right. Thank you, first of all, Chee Min, for your precious time, and also Yi Sin for hosting this wonderful fire chat session. So I think we have some other questions, but due to the interest of time, we can't answer them. So we will actually send the link to everybody to actually rewatch this on our YouTube channel, right? So with that, we'll actually end this webinar here. Thank you, everyone, for attending this. All right. So any questions, you can email us as well. All right. Thank you, Chee Min and Yi Sin. Thank you, everybody.
Thank you, everybody.
Have a good day. Thank you. Bye-bye.